Why does it feel like everyone else understands money except you? What's a good credit score? Should you invest or pay off debt? Why does inflation make everything worse? And how are some people getting rich while others stay stuck? Today, we're breaking down the financial questions everyone secretly Googles, but explains simply, clearly, and without the Wall Street jargon. By the end of this video, money will make more sense. Let's start with the one question most people are too embarrassed to ask. What is money really? Money isn't wealth. It's a tool. At its core, money does three things. 1, it stores value. 2, it lets you trade. 3, it measures value. In the U.S., that tool is controlled by the Federal Reserve. When they increase the money supply, more dollars exist. When more dollars chase the same goods, prices rise. That's inflation. And that leads to the next big question. Why does inflation feel so brutal? Inflation isn't just prices going up. It's your money buying less. If inflation is 3% and your savings earn 1%, you're losing 2% in real purchasing power. That's why people feel poorer even when their salary hasn't changed. Inflation quietly punishes savers and rewards asset owners. Which brings us to, why do the rich keep getting richer? Because they own assets. There are two types of people financially: people who work for money and people whose money works for them. Assets like real estate, stocks, businesses. When inflation rises, asset prices often rise too. Look at the S&P 500 over decades. It trends up, not because the economy is perfect, but because businesses grow, innovate, and raise prices. Wealth is built through ownership. Income pays the bills. Ownership builds freedom. Should I invest or pay off debt? This is one of the most common financial dilemmas. Here's the simple rule. If your debt interest rate is higher than what you reasonably expect to earn investing, pay off the debt. A credit card at 22%? That's a guaranteed negative return. But a 3% mortgage, you might invest instead. Debt isn't automatically bad. High-interest consumer debt is dangerous. Low-interest strategic debt can be useful. Money is math, but also psychology. If debt stresses you out, eliminating it may be worth more than the numbers suggest. What is a credit score and why does it matter? Your credit score is your financial reputation number. It tells lenders how risky you are. In the U.S., scores typically range from 300 to 850. Higher score equals lower interest rates, and lower interest rates over decades can mean tens of thousands of dollars saved. It affects mortgages, car loans, insurance premiums, and even job screenings in some cases. It's not about being rich, it's about being reliable. Why is buying a house so hard now? 2 words: affordability squeeze. Home prices surged, mortgage rates rose, wages didn't keep up. When rates rise, monthly payments explode, even if the home price doesn't. A $400,000 house at 3% feels very different at 7%. Real estate isn't just about price, it's about monthly payment and timing. And timing leads to the next question. Can you time the market? Short answer: no. Even professionals struggle. Trying to jump in and out based on headlines usually leads to buying high and selling low. Historically, missing just the 10 best days in the market drastically reduces long-term returns. The Dow Jones Industrial Average has crashed many times and recovered every time. The real strategy isn't timing the market, it's time in the market. Consistency beats prediction. What is compound interest and why does everyone talk about it? Compound interest is money earning money that earns more money. If you invest $10,000 at 8% annually, year 1, $10,800, year 2, $11,664, year 10, over $21,000.
It accelerates over time. That's why starting early matters more than starting big. Small amounts plus long time horizons beat large amounts plus short time. Time is the most powerful asset most people underestimate. Why do people with high incomes still feel broke? Lifestyle inflation. When income rises, spending rises with it. New car, better apartment, upgraded vacations. If expenses scale with income, freedom never arrives. Wealth isn't about how much you earn, it's about the gap between what you earn and what you spend. Control the gap, you control your future. What's the simplest financial framework to follow? If everything feels overwhelming, follow this. 1. Spend less than you earn. 2. Build an emergency fund, 3 to 6 months of expenses. 4. Eliminate high-interest debt. 5. Invest consistently in diversified assets. And 6. Be patient. That's it. No hacks, no secret crypto trick, no magic stock tip. Financial success is boring, consistent behavior over decades, and the people who win aren't the smartest, they're the most disciplined. Money feels complicated because it's often explained to sell you something, but the fundamentals are simple. Understand inflation, own assets, control debt, stay consistent. That's the game. If this helped simplify money for you, drop a comment with the financial question you've always wanted answered. And if you want more breakdowns that actually make sense, subscribe, because understanding money isn't about getting rich overnight. It's about not being confused anymore.